We come into the new week contending with the disconnect in financial markets. On the one side, currency traders continue to worry about the Fed's ongoing commitment to higher for longer policy, which has left the US dollar in the driver's seat. On the other side, US equities have ignored this worry, with investors continuing to expect the Fed to relent and defer to a more accommodative policy track. There had been some optimism around the avoidance of a government shutdown in the US, which could have contributed to some of the recent equity market gains. But into the new week, reports have come out that say the US still faces a risk of government shutdown at the end of this week, despite the latest compromise plan. And ultimately, as is always the case, we don't really expect there to be a government shutdown that would impact markets, with the expectation that the can would just continue to get kicked down the road. The main takeaway in financial markets right now is whether or not the Fed will relent or whether it will be forced to continue with its course of higher for longer. If it doesn't relent, we should expect stocks to once again come back under quite a bit of pressure. We also still see plenty of geopolitical risk out there, which would make the argument for being cautious about expecting any meaningful continuation of the latest run higher in stocks. It will be worth keeping an eye on the yen today, which is at risk of sinking below the 22 low against the buck to a fresh multi-year low. This could be enough to get a more aggressive reaction out from Japanese officials. Key standouts on Monday's calendar come from the German current account, U.S. consumer inflation expectations, and some scattered central bank speak. That's all for now.